Alright, so broad US equity and style ETFs. So what we're going to talk about this chapter is basically what it says here on the screen. Broad US equity and style ETFs. Can someone name what they think would be a broad US equity ETF or style of ETFs? No? Okay, great. Okay, so let me give you a little background here. The S&P benchmarks were the first to be licensed in 1992 for super trust units. Now, what do I mean by license? Why is licensing important for ETFs? What is licensing?
So you can be entitled to sell any funds?
Something like that, right? Entitled to sell the fund, or entitled to use, similar to franchise, when you think about it, right? Licensing. So, I can sell my fund as an S&P ETF. Let's just say it's an S&P 500 ETF. I can't use their, even though like my mutual fund firm or my ETF firm is called, AAA Advisors, right? I can't use the S&P's name without their permission, right? They're not just some free company. They're in the business of making money, right? So the S&P will license their benchmark to me, and I'll be able to use their name as a benchmark for my fund. This is another cost component of any investment manager. When you want to use a benchmark for anything in a professional way, you have to pay the benchmark provider so they send you the information. I mean, is it possible to get the information from the benchmark provider without paying for it?
Yes.
Yeah, absolutely. Sure you could. Would it be a pain in the butt?
Yes.
Would you not have the information right away? Sure, there'd probably be a lag, right? It just wouldn't be as efficient. And if they found out, well, you'd be in trouble, right? They'd probably go after you legally. Industry Spider ETFs debuted in 1998. Those are the first true ETFs by State Street Global Advisors. And broad market style and size ETFs were introduced in 2000. So what we're seeing here is that ETFs are really, really new, and they kind of have just grown extremely rapidly. Why do you guys think they grew so rapidly?
Because they trade throughout the day?
I wouldn't say that's the number one reason. That's a reason.
You won't lose as much as you lose trading one stock.
You're diversified.
Yeah, and then you gain more than your regular mutual fund.
Okay. I think the number one reason is because it became easier for retail investors like us to trade like institutional investors, right? Before, if we wanted to buy a certain benchmark, if I wanted to buy, I forget the name of the Brazilian benchmark, but we'll just call it the Brazilian benchmark. If I wanted to buy the Brazilian benchmark, how would I do it 20 years ago?
Mail,
you wouldn't be able to, there were no ETFs. You couldn't buy it by mail. You would have to buy like individual securities, And there probably wasn't too many mutual fund providers creating a Brazilian mutual fund at the time either. So it let retail investors trade more like institutional investors, right? We could buy large funds. We could easily diversify, low cost, right? Transparent. Now, business of licensing. By the year 2000, index providers negotiated ETF licensing deals. Okay, so benchmark providers were actively seeking this business. It was a new stream of revenue for them to license their benchmarks to ETF providers, right? Before, they would just license their benchmarks to what? As a benchmark for maybe an institutional investor or a certain fund or a mutual fund, right? But the whole world of ETFs led to a new stream of business for them. The first competitor was Russell, the S&P, and then others came down, including Dow Jones, Wilshire, MSCI, and Morningstar. The first custom index ETF was the NASDAQ 100 in 1999, and it was the NASDAQ 100 which didn't include financials, so I wrote ex-financials there. Now, just looking back, why was that created in 1999? Big technology boom, right? And financials weren't part of the technology boom, were they?
Internet boom.
Internet boom, right? So they created that product as to meet the demand of the market, right? Because people were looking to maybe get into technology stocks, but they didn't know which ones to pick, or they didn't have the time to look into it. But they saw the NASDAQ, which is like, you know, when you see the financial news, you see, you know, Dow Jones, the S&P, the NASDAQ. They see the NASDAQ going up every single day. They want to get a piece of the action, right? They want to buy into the NASDAQ. It's an easier investment, right? You don't have to pay attention. It's a very, like, ETFs in general, I've said this before, very macro-oriented. By macro, I mean, you know, like big picture, right? You don't have to focus on, like, the financial statements of any particular firm. You can look at the industry overall, which I like that. For me, I like that style of investing better. So that's why that was created. And much like any other ETF out there or investment product, they're created because there's a perceived need by the market for a certain product, right? So a series of custom index ETF launched in 2003 by PowerShares. PowerShares does a lot of really funky ETFs. Like they'll do like a triple levered S&P 500. Do you guys know what I mean by that? No. Radio silence I got there. Okay. So PowerShares does some unique stuff. For example, a triple levered S&P 500 ETF would mean that when the S&P 500 went up 1%, the ETF would go up 3%. You know?
Oh, so it's triple.
Yeah, it's like you're tripling down on your money, right? But the same thing happens in reverse. Is that when the S&P 500 goes down 1%, you lose. They also do other unique styles. They'll do inverse ETFs, and they'll also do levered inverse ETFs. So an inverse ETF would mean the opposite would happen. So if the S&P 500, it's like short selling, right? But it's short selling. Buying an inverse ETF is short selling without having to sell short anything. Like the nature of the fund short sells, but you don't have to. So for some reason, you're in a job that says, hey, we don't allow short selling. Well, you don't need to short sell. You can just buy an inverse ETF. So S&P 500 goes down 1%. The inverse ETF goes up 1%, right? And this can also, when the market's tumbling, and if you think that the market's going to continue to tumble, you can make money on that, you know, and say, all right, I'm going to buy a triple levered inverse ETF. So whenever the market goes down 1%, I make 3%. Now, obviously, that's a really risky strategy. But there, you know, I've tried some of these out myself. There are some really interesting strategies, like kind of like a seesaw strategy, where you can kind of buy a levered ETF and an inverse ETF, and then kind of hold them both, and then try and time it. So when the market goes up, you sell one, and then when the market goes down, you sell the other one, and try to make money on like the volatility. Do you guys know what I mean?
Yeah.
Thank you. So
that's what I did last year.
You invested that, or?
No, investing portfolio.
All right. Oh, nice job anyway. Yeah. So, yeah, if there's going to be a lot of volatility in the market, and the stock market's going up and down and up and down, one investment strategy would be to buy an inverse ETF and a levered ETF. And then when the market's going one way, you sell one, and when it's going the other way, you sell the other. Now, obviously, there's a lot of timing involved in that, and it's not a perfect science. It requires a lot of, you know, having a good feel in the market of where it's going. Also, when you buy ETFs, interest, you know, the Fed is a lot more important. You know, for example, when Facebook goes public, it doesn't matter what the Fed has their interest rate at or anything like that. The Facebook stock will probably operate kind of separate from the rest of the market, right? It'll probably just go up for a while, right? But if you're invested in a whole index, an entire market, when the Fed says, all right, we're going to lower interest rates, that's probably going to make the S&P 500 or any domestic index shoot up, and vice versa. Eventually the Fed is going to raise interest rates, and they'll probably raise interest rates when the stock market starts going up too much. Now that might sound weird, like when does the stock market go up too much? Well, the stock market can go up too much too quickly, and when that happens, you can get things like inflation and stuff like that. If inflation gets too high, that's very damaging to the investor's confidence. Okay. Index style and components. Broad index ETFs measure the pulse of the market, right? So we're talking about the domestic market here. So if we have a broad index ETF, like, for example, the Wilshire 5000 measures what? Yeah, exactly. It's virtually all the stocks in the U.S. So the Wilshire 5000 will tell you pretty much, depending on how you weight it, or or how you judge the weighting, it's going to be a good measure of the overall economy, right? And that what broad market indexes do, or broad market ETFs. S&P 500, is that as dynamic as the Wilshire 5000? Why?
That's less.
Has what?
Stocks.
Less stocks. What stocks does it have?
500.
The top 500 companies, right? Top 500 biggest. So, often referred to as an all-cap or total market approach. We're talking about the whole market. Broad market indexes are divided into size components based on average size of the companies they hold. So they won't say, you know, like, all right, well, this one stock hit a certain level. All right, we're going to move it into this other category. It's going from mid-cap to large cap, or it's going from small cap to mid-cap. It's based on a weighted average. So just if a stock shoots up one day, it's not going to push it into a different category. And all this depends on the benchmark's methodology. All the different benchmarks don't have the same methodology in terms of including one stock in an index. You know, one stock in a large cap index could be a mid-cap stock in another index, depending on what kind of methodology they use to, you know, decide what's a large cap or a mid-cap. Size reallocation is done periodically. I believe the S&P 500 reconstitutes its benchmark in June, every June. So it kind of reevaluates the top 500. I think I've said this before. They'll look at the top 500 companies, and some might drop off, and other ones might come on. Styles divide index and sectors into value and growth components, or neutral components, right? Neutral would be that sweet spot in between value and growth. As I said, repeating myself, different index providers have different methodologies for deciding what's value, what's growth. They'll be close, you know, but they're not going to be this. It's not an exact science. This is what I was talking about earlier. Chapters 7, 8, 9 were all about analyzing these index strategy boxes. These are something used by like Morningstar, and it's supposed to be an easy visual tool to see what kind of investment you're in. So, right here we're looking at a passive capitalization index, right? Now we have a screened, and we have a quantitative. Now, screened is somewhere in the middle between quantitative and passive. And just to touch base on this really briefly. So, what do we think of when we hear the word screened? What are we doing?
Take away some garbages.
Take away some garbage. Now, what would we consider garbage?
Non-performing.
Okay. Let's say I'm the Catholic Church. Okay. And we're very holy and righteous and all this other pious stuff. What stocks would we not want to invest in as the Catholic Church?
Jewels.
No.
Abortion.
Okay. That's a little tough. There's no abortion stocks.
Oh, you never know.
I'm going to have to edit that out here.
Prostitution stocks.
Prostitution, there's no prostitution. So, weapons, pornography,
Yeah.
alcohol,
That's what I meant when I said.
tobacco. I mean, serious now, right? So, an organization like the Catholic Church, all right? An organization like the Catholic Church would want their stock selection screened to make sure those are removed: alcohol, tobacco, pornography, and weapons, right?
Is there pornography?
Huh?
Is there pornography stuff?
I'm sure there is. We can research that off camera. Now, I don't even know if I can put this video up now. All right? I'm sure there is. Right? Huh?
Hey, girl.
Yeah, it's possible. That's what I intended to say.
Yeah, it's possible. Okay.
Came out the wrong way.
I could ask an interesting question. You know, all those things though: alcohol, tobacco, firearms, pornography. Are those going to be high beta or low beta stocks?
Depends.
Low beta.
It depends, but in general, what would you say?
I think they'll be low beta.
They are, right? Do people smoke less cigarettes during the recession?
No.
Not significantly, right? I'm not going to ask you about anything else, right? I'm not going to go down the list here. But, like, people aren't, we'll leave it at that. People aren't smoking less cigarettes during the recession. At least not significantly less cigarettes. It's the same.
More.
What's that?
Even more.
Maybe even more. Maybe stress, right? They start smoking more cigarettes. You don't know. It's almost along the lines of groceries, right? You're not going to stop buying groceries. You might change your basket of groceries, but you still are going to go feed yourself, right? You might switch from filet mignon to macaroni and cheese, but you're not going to stop going to the grocery store. They're still going to get your money, right? Just like gasoline. So this is just showing the market index penetration. And by market index penetration, I mean how many stocks do these index providers use, okay? So we see the smallest one is the S&P 500, okay? So we have the S&P 500. I believe it works like this. The large cap is the S&P 500. The mid cap is the S&P 400. And the small cap would be the S&P 600, which would do the math, would create the S&P 1500, which you don't see too often. Not many people would use the S&P 1500 as a benchmark. At least in my industry, I haven't seen it too often, ever actually. Dow Jones, Morningstar, go to about 1850. MSCI goes to 2500. And we see right here how they break them down, right? The S&P 500, Dow Jones, Morningstar, and MSCI don't go into microcap, right? They don't go into the smallest companies. From a business point of view, why wouldn't you want to benchmark the smallest companies?
Higher risk.
No, because they're not actually, the benchmark doesn't actually have to invest. That's the beauty of it. They make all their money through licensing. They just create the benchmark. They don't have to buy anything. Why don't all these companies go down to 5,000?
Diversification.
Broad.
It's the best return.
The reason is because if we're creating an ETF or a portfolio, the microcap stocks are very illiquid. So they're hard to replicate in an ETF, right? Because they don't trade very often. And so what's the point of benchmarking a stock that you can't trade, right? That makes sense? The most common index providers I see are the Russell and MSCI. I actually see MSCI used more than anything. So, but the Russell and the MSCI are the big ones. Occasionally I see the S&P as an index. And this is just showing more of the style charts, right? So this style chart right here is the broad market index. It has everything. This would be composite style index. Composite style, value, growth, neutral. Composite cap index, large, mid, small. And then style indexes is basically cutting this up, a variety of different ways. I actually found a way to cut pages out of my Kindle app and put them on the computer, so I've been able to start cutting stuff out of the Kindle pages, which is nice. That's where I got those from the book. Okay. S&P equity index. So right here, I'm going to go over a few of the equity indexes and just describe a few differences between a few of them. Okay. So the S&P equity index, it is the most popular benchmark in the U.S. Now, I decided I don't see it that often. That could be because a lot of the investing my clients have done have been in global portfolios, right? So if you're going to do a global portfolio, the U.S. S&P 500 benchmark is kind of useless, right? You'll be wanting to use a broader benchmark like the MSCI or the Russell, okay? Over $1 trillion is invested in their products. So if you added up all the S&P ETF or investment products, you'd have $1 trillion. Okay. It is not the most complete index. I ask why. We already know why, right? Because it doesn't encompass all securities, right? It only goes down to what? 1,500. Okay. As I said before, there's an S&P 400 mid and an S&P 600, which is the small cap. Okay. Adding these three up creates the S&P 1500. Okay. Dow Jones Wilshire indexes, launched in 2000 as a total market index, which represents 95% of the market. Like you said, I think it's like 98 point something, but the book probably simplifies it. The Wilshire 5000 is almost impossible to replicate exactly. Why?
Because again, too many different companies.
Too many different companies, too many micro-cap companies that don't trade very often, right? So it's harder to replicate. The Russell indexes, most popular ETF, at least when the book was printed, was the iShares Russell 2000 small cap. Okay. The Russell 3000 measures the 3,000 largest companies. Russell constructs its indexes annually. As most of these indexes, I don't know why the book put that in there, but pretty much all the indexes reconstitute their benchmarks, at least annually. Okay. And lastly, the MSCI, I have this here, created in 2003 with the help of Vanguard. It has 3 market cap segments: large, mid, small. Okay. Uses a migration methodology for reconstructing their index. I want to go into that for a second. So they use a migration methodology. So that means if a company is kind of on the border between a mid cap and a large cap, they'll include that company in both indexes for a period of time until it migrates one way or the other. And they say they do this so that people can't, like front run ahead of a benchmark change, right? Because anybody could look, the methodology for their benchmarks is fairly common knowledge, right? If you want to understand it, you could look it up, read about their methodology. It's not in these books. It doesn't give a complete methodology. But you could research it and find out their methodology. And then if you know the weighting of the stock, right, its cap weight, then you could predict whether a stock is going to enter or leave a benchmark. And when stock enters a benchmark, as a general rule, when stock enters an index, especially like a big one like the S&P 500, it's going to go up in value because now it's going to kind of get like added prestigious value, right? And when stock exits a benchmark, it's probably going to lose some value because why? It's not going to have that exposure on being on that benchmark anymore. Pierre, do you have a question? You give me like the stake guy.
No, I'm kind of looking something on Google too, as you were saying something.
Okay.
Yeah. No, you got to the benchmark.
All right. You look like you were about to say something, so I wanted to stop you. So that's one theory of doing it this way, is to prevent front running, right? Because that would be a great trading strategy, right? Buy a stock before it's on the benchmark, when you know it's going to be included in that benchmark, and sell a stock when you know it's going to leave the benchmark, because you know it's shrunk. Because they don't take away stocks or add stocks to the benchmark every month. Like I said, it's usually done every year or every 6 months.
What if it's not because the stock is not good, it's just that you want to move away from a certain sector?
It's a great question. I don't think they would do, like, so for the S&P 500, right? I don't think they're going to reconstitute something because one sector is heavy weighting. I think the weighting depends on the market cap of the companies that make up the S&P 500. So, for example, if we're in a really strong technology phase, and all of a sudden now there's a higher percentage of technology stocks in the S&P 500. Well, that will happen naturally because technology is on an upswing, and now more technology companies have become part of the S&P 500. It's not like S&P 500 is going to say, all right, we only allow 7% in energy, so we're going to pick the top energy companies and only hold that allocation 7%. Does that make sense? And I think just the way the market is, nothing is going to shift so dramatically. It's not like we're going to have 90% of the S&P 500 in technology stocks. You know what I mean? At least not in the U.S. because it's such a diverse economy. Now, when you look at other economies, right? I'd have to look this up, but I know India is really heavy into technology. So if you were kind of making a technology play, buying like an Indian benchmark ETF might be a decent technology play, right? Why? Anyone know why India's heavy in technology? Yeah.
Because it's cheap, but at the same time, the quality.
Cheap, educated, right? Yeah. I mean, look at your day-to-day, right? I mean, none of us call 800 numbers too much, right?
Help desk.
But help desk, where are a lot of them located?
India.
India. I mean, that's a technology job. I mean, as silly as that sounds, that's a technology job. You know, routing phone calls from the U.S. to India is a technology job. You know, and that's a big business. You know. I think this is fundamental and quantitative indexes. Okay, fundamental indexes screen an index for securities such as non-dividend paying stocks. Right. So we can create a custom index saying, okay, this index is going to be the Russell 2000 X dividends. So no dividend paying stocks are going to be in this this index. And as we said before, quantitative indexes are based on a variety of multi-factor models. I just wrote factors again in parentheses to kind of emphasize that. So quantitative models, again, they're heavy math models based on a variety of formulas that are supposed to, the investment manager believes, add value to their investors. Right? Next. Okay. I probably shouldn't have even included this, but it was part of the book, and I was going snippet crazy, adding pages from the book inside the slides here. It just gives a variety of different broad U.S. equity ETFs. So the large blend Spider S&P 500, that's the big daddy of ETFs. I think it was the first one. SPY, it's just your plain vanilla S&P 500 ETF. And then it also tells you the strategy box up here. Then it goes down the list. It has the iShares S&P 500, which is the same thing as the State Street S&P 500. It's just another competitor, right? Then they have the iShares S&P 100, the iShares S&P 1500, down, 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 down. I believe the way the list worked, this list ended up being like 10 pages in the book, and I believe it was just showing, large cap all the way down to micro cap. Yes?
What's the PS, securities selection? PC, what does PC mean?
I'd have to look that up.
What does this PS mean?
Oh, passive.
CF.
Service.
CF. How about CF?
CF. It probably should be right in there. I didn't memorize that. I'm sorry.
Oh, I mean, what does this stand
He's saying about in the Boston Globe or the terminal.